Welcome to another video on the topic financial statements. In order to perform any financial planning or financial analysis or any financial decision, we need the financial information about an organization. The financial information of an enterprise is contained in the financial statements or accounting reports. Now, there are three main financial statements used by owners, management, and investors for financial analysis. So, the three main financial statements are balance sheet, profit and loss statement, and cash flow statement. So in this video, we'll look at these three statements in brief, and in subsequent videos, we'll look at these in more details. So first, let's look at balance sheet. So the balance sheet communicates information about assets, liabilities, and shareholders' equity for a business firm on a specific date. So the balance sheet of a firm prepared on, let's say, 31st March 2018 reveals the firm's financial position on this specific date. The balance sheet is based on the fundamental equation that assets is equal to liabilities plus shareholders' equity. Now, a simple balance sheet structure can be represented in this form. So, total assets is equal to total liabilities plus shareholders' equity. Now, total assets comprises of current assets plus non-current assets. Total liabilities comprise of current liabilities plus non-current liabilities. And shareholders' equity comprises of share capital and retained earnings. So as you can see, a typical balance sheet is divided into two sides. The left side of the balance sheet outlines all of the company's assets, and the right hand side outlines the company's liabilities and shareholders' equity. Now let's move to the second financial statement, which is profit and loss statement. Now the profit and loss statement is a financial statement that summarizes the revenues, costs, and expenses incurred during a specified period, usually a fiscal quarter or an annual year. So you typically see revenue, cost, and expenses. This statement is also known as an income statement. Now, in other words, the profit and loss account is a scoreboard of a firm's performance during a period of time. So this would be, like a profit and loss statement would be, let's say, from 1st Jan 2017 till 31st December 2017. So this profit and loss will tell you about the revenue, costs, and expenses for that period. Whereas the balance sheet is as on a certain date. So this balance sheet will be as on 31st December 2018. What is the status of assets, liabilities, and shareholders' equity for the firm? Now, a typical P&L statement starts with revenue, which is also known as the top line. And subtracts the cost, such as cost of materials, operating expenses, tax expenses, etc. Now, the difference between revenue and cost is known as net income, which is also known as the bottom line or profit or earnings. So net income is known as bottom line. So this is how a typical P&L statement looks like in a very basic form, okay, just so that your basic understanding is clear. So typical P&L statement, 12 months ended 31st March 2018. That means this is for a 12-month statement from 1st April 2017 till 31st March 2018. So sales and revenue, let's say XXX rupees. Operating cost, which consists of COGS, which is cost of goods sold, selling expenses, R&D expenses, etc. So operating costs total to YYY. And then the profit will be XXX minus YYY. So this is the P&L statement. Now let's move to the third type of statement, which is the cash flow statement. Now the cash flow statement reports the cash inflow that a company receives as well as cash outflow that it pays during a given period of time. So basically this deals with cash inflow and outflow. Now it is very important to understand the most important difference between an income statement and a cash flow statement. Now assume that a company sells a product to a customer on 1st of August 2018. The payment term says that the customer can pay in the next 30 days of the sale. Now, as on 1st of August, the company can show this amount as its revenue in the income statement. However, it has still not received the cash payment, which probably will come on 30th of August, after which this amount will start appearing in the cash flow statement. Now the cash flow statement can be broken down into three different parts. So let's look at them. So the first one is cash flow from operating activities. This lists the cash flow from the operational business activities of an organization. So basically whatever is the main business that the company is in, the cash flow from that operating activities is listed under this head. The second one is cash flow from investing activities. Now this includes any cash flows from the acquisition or disposal of long-term assets such as property, equipment, plant, etc. While positive cash flow within this section can be considered good, investors prefer companies that generate cash flow from business operations and not from investing and financial activities. So let's say if a company is into manufacturing of furniture, then the first part, which is cash flow from operating activities, that is the cash they are getting by selling furniture. And the investing activities is if they have acquired some land and they sell it off and then they get some money, that is the cash flow from it. That is the second part. Let's look at the third part. The third part is cash flow from financing activities. So this section lists cash inflow or outflow from equity or debt, loans taken or paid, dividends payout, share buybacks, etc. So these are the three main sections of a typical cash flow statement. So as you have seen, these three statements, that is the balance sheet, profit and loss statement and the cash flow statement, are the three main financial statements for an organization. In subsequent videos, we'll cover these in more details.